All right, everyone, we will get started momentarily. Kwhame, are you situated? The broadcast has started. Kwhame, can you hear us?
Yes, I can hear you guys. Thank you so much.
Okay, great. So I'm going to go ahead and kick it off because we are already on the air. So to all of the attendees that are dialed in, first of all, I want to thank you for joining us today. My name is Mitch Ackles. I'm the president of the Hedge Fund Association, and we'd like to welcome you to the HFA webinar, Opportunities in Energy Markets. The HFA is a global nonprofit industry trade and nonpartisan lobbying organization. Our mission is to advance transparency, development, and trust in alternative investments. We will follow up with you if you are not already an HFA member after this event with some additional information about HFA. I'd like to thank today's webinar sponsor, Argus Media, and Kwhame and Vlasios in particular for participating today and helping HFA create this program. I'd also like to thank HFA's annual thought leader sponsors, Citron Cooperman and UMB Fund Services. After our panel discussion today, we will open it up to audience questions. In your GoToWebinar box at the very lower part of it, you will see the question box. If during the course of the webinar you have a question, please type it into the box. Excuse me. And Kwhame, our moderator, will do his best to ask the question during the course of the program. But if we do not get to your question, please be advised we will record it and we can certainly follow up with you after the program. Now let's meet our panelists. Today with us, we've got Vlasios Voudouris, who is the Chief Data Officer from Argus Media, Brynne Kelly, who's Director of Research at Cornerstone Futures. Sandra Myburgh is the CEO of FERN Impact Partners. And I'm going to turn over the webinar to our moderator today, Kwhame Gittens from Argus Media. So Kwhame, please take it away.
Thank you, Mitch, and welcome everyone. As Mitch mentioned, just some housekeeping rules. First, I'll introduce myself. As Mitch said, my name is Kwhame Gittens. I am the Senior Vice President of Argus Sales for the Americas. We'll have a presentation by Vlasios on possibility curves. Then Brynne will do a presentation on the oil market structure. And then we'll go to a question and answer session with Vlasios, Brynne, and Sandra. We do have some pre-prepared questions, but feel free, as Mitch said earlier, to type any questions you guys want in the question area, and I will interject. So when we get to the question section after Vlasios and Brynne are done, any questions you want to direct to Sandra, Brynne, or Vlasios, just type them in, and I'll have a few questions to get us going. With that, Vlasios, I turn over to you.
Thank you, Kwhame. Hi, everyone. And I hope everybody is well, given the situation that we face with COVID. My name is Vlasios, and I'm actually speaking to you today from London. So one of the things I want to discuss with you today is effectively how can we design some new signals that can help people make trading decisions. And I say new signals because a lot of the premise that we make at Argus is that there's quite a lot of things we can do by using what we call the physical transactions data. And by physical transactions data, we really mean the volume, which is how much, let's say, oil or refined products move around the world and at what prices. And what you see on your screen right now is effectively some of the key transaction data that we as Argus are collecting. And I would like just to emphasize a few of them. So if you look at the first box, which says Europe, one of the first assessments we make is the Argus Eurobob. And that is effectively the most liquid assessment that happens for the European gasoline. And the whole idea effectively of making this assessment is to provide transparency in the market in Europe. We will also make the assessment in North America, and that you'll see something called WTI Houston. And if you're not familiar with that, this is our benchmark, which effectively represents the price of the US crude that it is for export. If we move along that map, you see assessments in Latin America, in Africa, Middle East, Russia, Asia Pacific. So the whole idea is that we are a company that is collecting that physical transactions data globally, and by that data we mean both volume and prices, and we try to capture what's happening both globally, but also in different regions, the different grades of crude that are transported globally. So why is this important with respect to supporting trading decisions and effectively try to use that with the data science? So if we use the example of COVID, what has happened at the very beginning, about more than a year back now, when we were running our analysis, we actually start observing that a lot of the physical price assessments that we make in Asia Pacific, and specifically the assessments that we make with timestamp in Singapore, they were becoming really important to assess the volatility in the US and for in respect to the crude, but also the volatility in Europe. And our premise here is that there is some unique insights that we can get from the physical price of what's happening in the physical world with respect to the events that are unfolding gradually. So there is an event that is impacting the market, but that event is not one-off, but the impact of that event is coming in on a gradual manner. And our premise is that the physical price are really important to actually use in the derivation of signals that supports trading. If we go now to the next slide. So the whole idea is that you have a lot of different things that can affect the prices. Of course, there are physical prices that happens around the world. There are also drivers from the financial space, like the futures markets and the shaping of the futures curves. There is also a fundamental supply and demand that can affect. And the whole problem becomes even bigger because that effect that it has can change over time, and it can become bigger or smaller, or it can become positive or negative. So what basically we suggest is to try to use data science that can turn all that data set into insights, and insights that can basically support human decision making. So this is not something that a human cannot do. We just claim that we can use data science and put all the data in a structured way that you can do it at scale. And effectively what this means at scale, when we move to the next slide, is to see how we can actually organize that for the different crude grades. So if we can go to the next slide. So in the next slide, what we've done here is that we use as an example Brent for December and January, and WTI for November and December. And we say there are some drivers that actually affect the Brent grades, the WTI for the specific delivery contracts, but there are also drivers that are affecting all of them at the same time. And that's what I highlight actually in the middle. And this is where is the real value of data science, is trying to find out drivers either from the financial space or from the physical space or the fundamental space that can move effectively all of them at the same time. And the idea is that how do we do that, why this is important, and how do we build the infrastructure to do that in a systematic way. So Mitch, if we go to the next slide. So in the next slide shows how we as Argus have done that. So this is not to suggest that this is the only way to do it. This is just to say how we actually put together some public data or some unique Argus data set to create what we call the Argus universe, and then use that Argus universe with a data science framework in order to effectively shape what we call the possibility curves, which is an idea of effectively providing an estimate of the uncertainty in the market, but also the drivers behind that uncertainty in the market. And the claim that we make is that the data science offers that, if you like, process in a systematic way, and what is really, really important is how you design that Argus universe. And the Argus universe, in our case, is not made up just of the unique data set of Argus, but also we enhance that with public data. And what this enables us to do is effectively to create uncorrelated signals. So signals that can add something on top of what the market is using currently, and that is based on the deals data set, which is the price and the volume. But if we look on the right side, the other thing that we say is that it's not just one thing that affects the formation of the prices. So what you see on the right side and the bottom figure is that there are basically three clusters of drivers that can affect the shaping of the possibility curves. The first one is the physical prices, the next one is the financial drivers, and the last one is the fundamental drivers. So you need all of them in order to properly understand what's happening in the crude market. It's not basically one or the other, and which one is more important or less important, this will also change over time. So Mitch, can we go to the next slide? And this is an example of which of the key drivers that we have identified are important in terms of driving the volatility and the balance of risk in the oil market for effectively 5 days. So if we look at the top row, what this one is telling you is how important is the driver over the last 22 trading days, and how important is the driver for the last trading day. And what we see is that the most important driver for the first day was basically the gasoline, the processing of the refineries, the gasoline that comes from the fundamental space. The second most important driver was actually the spread from the futures contracts. And later on, there will be a presentation about how we can use information from the futures contracts to understand structures in the market. And that's actually confirmed to us is that there are areas where the shape of the futures contracts actually is important, is shaping the possibility curves and therefore the volatility and the balance of risk that you can derive from that. But as we move down from the first day to the last day, you will notice that a lot of the physical price assessments are becoming important. And the point I want to make here is that from the third day, the Argus assessment in the heating oil is actually very important, and then it becomes the CPC blend assessment that becomes really the most important driver towards the end of that period that I show you on that graphic. So the idea here is that something can happen on the demand side because of on the crude oil globally that makes the CPC blend assessment that we are assessing in the Caspia region a really important driver to balance, to estimate the volatility and the balance of risk for the crude market. And that confirms back our premise, which is you need things from the physical space, the financial space, and the fundamental space to properly shape the curve. And when I say shaping the curve, I mean the one that you see now in front of you, which is basically that is show you how you can estimate the different probabilities to observe a price outcome. So this is not about saying tomorrow the price of oil will be $60 per barrel, but this is about to say, given the current market drivers, what's the probability of having the price within a certain range. So the example you see here, this is for the 8th of March. So when the price opened at $67.45 per barrel, and effectively using the possibility curves, we were estimating that there is only 6% chance that the price will be above that. So what's happened for the remaining of the day? Effectively, the price opened at the very top of the possibility curve, and then basically slightly down and closed towards the lower side of the tail of that curve. And we want effectively to make that argument is that the reason why that shaping you see was done, if you like, appropriately, is because you are using information from different spaces, and the drivers are affecting this curve in different ways. So there can be one set of drivers that are important at the top of the curve, and there can be another set of drivers that are important at the bottom of that curve. And estimating this shape properly requires you to basically have some sort of a unique data set about what's happening in the physical space. So if we go to the next slide, you will see that this is an indication of basically what's happening in our shaping of the curve towards the center and towards the upper tail. So if we take the center of that curve, the most important driver for that example was the total volume of crude trades that Argus is recording. This is the total volume of crude globally for Argus that are traded physically. And that affects a lot the lower side, the center and the lower side of the possibility curve. The second most important driver was the stock levels for distillate fuel oil published by the EIA. And then we have the influence from the futures contracts, both from the Brent and the WTI. But when you try to shape the curve at the top of that curve, at the top of the mountain, then the most important driver was actually the US stocks distillate fuel oil, and then the next was from the futures contracts. So you see that different in the different areas of the curve, different drivers can become more important or less important, and that is really important when you are trading to understand which part of the curve you are using for trading and which drivers are affecting that part of the curve that you are using to extract your signal. So if we go to the next slide. And this is where, in the next slide, where we try to put everything effectively together, which is to show you in the form of the colors, the different ranges, the different intervals for the possibility curve. So on the left side, you see the most important drivers for Brent, and on the right side, you see the important drivers for the WTI. And the colors you see in the intervals, that shows you effectively the 50%, the 80%, 90% intervals. And the line you see at the very top shows you how important is a particular driver to shape the specific interval within which the price can be observed. And one of the things that you might notice that's kind of interesting is that U-shape that you see based on the heating oil assessment. So the heating oil assessment that we make is very, very important, by far the most important driver when you try to shape the very top of the curve and the very bottom of the curve. So it is important for the sender, but what really makes a difference is when you try to estimate the big jumps in the market, either positive jumps or negative jumps. And if we go to the next slide, you will see now that once you have shaped that curve using the drivers, you can then start creating new trading signals. And that signals are based effectively on quantiles. So what we have done here is that we actually take specific points along our curves and we derive a set of statistics that can be used for trading. So one of the most important signals we discover is the interquantile range, and that the interquantile range is effectively a proxy for the volatility. But then we have what we call the central skewiness, and the central skewiness is effectively the asymmetry around that volatility. So by using the possibility curve effectively, you can start thinking about new signals in terms not only for the volatility, but the asymmetry around that volatility. And if we are in a period of really high volatility regime, then you're going to start thinking about the tail skewiness. So this is not the skewiness in the center of the distribution, but the skewiness effectively towards the tail. And if I want to link that back to the discussion about the drivers, we can then go back and look which of these drivers is important if I'm focusing my trading strategy on the tails, and which of the drivers are important when I'm focusing my drivers on the central skewiness, because different market drivers will actually shape that curve that you see in different ways. If we go to the next slide. So what we have done then here is that, okay, so we are now having the possibility curves. We know which drivers are shaping each of these intervals. So what can I do? So what we've done here is basically we overlay these white lines that you see that are effectively are suggestive when the market is overheated, either on the overbought side or the overshot line. And these act basically as alerts. So if the daily prices starts going towards the crossing the lines, that suggests there is level 1 of an overbought, level 2 all overshort, and when it crosses the lower lines, it suggests effectively the exact opposite effect. So what you see here is that for that particular day, we were suggesting that the overall market suggests a negative skewiness. Therefore, there was a high probability the price will go down. And what's happened is that the price initially at the early trading hours hit our overbought level and then effectively dropped down towards the end of the trading session. It hit our overshot level and then it's bounced a little bit back. And this is the whole idea of the possibility. It gives you where is the different ranges of prices that can be observed, what's the probability of that. So whenever you open a sell position, then you have to decide at which point am I going to bank the profits. And the intervals you see can actually be used to estimate the expected profits when you are on the right side of the trade, or if you have opened here a buy position, to estimate the expected shortfall. So this is a combination of using, if you like, the lines for the overheating areas, but it's also to use the intervals to try to estimate risk measures in order to manage better when to close the position or when to basically to stop the losses. And in the next slide, we try to put all these ideas together. And our key argument here is that people are trading in different ways. And when you are creating signals that come from the physical space, there is a lot of opinions of what things might be driving both the possibility curves, but also the balance of risk, the volatility. And the whole idea of actually designing a platform is to allow people to introduce their own assumptions, to basically see that platform and say that there are certain things that I agree with a specific provider, but they have some different opinions about stuff, and I would like effectively to introduce some of my own assumptions there. The other advantage is we provide that information, especially the crude oil, for the individual grades like Brent, WTI, Mars, WTI, Houston, but you might want effectively to use the same capabilities to trade on the time spreads or on the grade spreads. And the clients basically, they can use some sort of a platform that we have in order effectively to design their own signals depending on the type of trades that they want to do. And for all of these grades, we basically have the same principle. You need to know what are the key drivers, in which aspect of the curve they are affecting, so that you don't just get the signal, but you get of why that signal was derived and what are the most important drivers that are impacting the signal that you are planning to use for your trading. And this is effectively the presentation. So thank you very much. And if you have any questions, I can answer them today or with a follow-up call. Thank you.
Thank you very much, Vlasios, for the insightful presentation. I think we'll have a lot of questions at the end, hopefully, about the market drivers. Clearly, the market drivers are central to the possibility curves and the weighting of public versus physical trading data. I will reserve some of the questions for the end because I know Sandra has a presentation. Also, I wanted to point out, Suzanne, I do see your question within the chat for Sandra, but I'm going to have Brynne do her presentation first, and then we'll start to do the Q&A session. So I do see your question in the chat, but I just want to make sure we can move on to the next presentation, and then we can start the Q&A section because the question is for Sandra. So with that, Brynne, over to you. We can't hear you.
Was I muted? Sorry. Hi, I'm Brynne Kelly. I'm currently the Director of Research at Cornerstone Futures. Cornerstone Futures is a global energy swaps, futures, options brokerage firm. And I'm also the founder of the Fundamental Angle, which is an energy consultancy and education firm in which we provide, one-on-one consultancy to specific clients. So kind of continuing on what Vlasios was talking about, he really got into, on a granular level, what are some of the data points used to, create price formation. And that, of course, filters itself into the oil markets, and all markets, but in this case, oil markets, and into the futures curve. And our clients use, the shape of this curve to determine, types of spreads that they might want to put on. And so I think it's important to take a look at what has happened over the last year in the structure of the oil markets. If you look at this chart I have up, the gold line is as of last night's settle, and that represents the January 2022 through December 2026 futures curve. So here is the shape of it. And currently you can see it's in backwardation where the front is higher than the back. The purple line, ironically, is where we were a year ago, just before this whole pandemic started. The curve was fairly flat, not really suggesting, a lot of possibilities or signals in the market. And then, we all know what happened. We had the loss of demand due to lockdowns, and the whole front of the curve shifted lower. And this red line is as of the beginning of May. So typically, the back of the curve tends to hold. And it needs the front of the market to kind of pull it up and down. And it's sort of found its equilibrium just above $50. And that's kind of important when you're looking at some of these long-term equity investments in some of the producers out there, that the real reason they're, selling so much, they lost so much value early or mid last year was that the entire structure of the curve moved lower. Subsequently, we've had a huge rally in the front of the market, and you can see once again, we've got the back of the curve into the equilibrium. And I think this is an interesting dynamic to note, because when you're looking at investing in some of these producers, if you already have a 5 or 6% slope in the curve, going into the future. That means your product is losing value the longer you hold it, or it has less value in the future. And in that way, in order for these companies to maintain their same revenue levels, they have to increase production or decrease costs greater than the slope of this curve. And that's just an interesting dynamic, as you know, there's a lot of talk out there about oil going to $80. And it's really, you know, what is the market trying to entice? What is the curve trying to entice out of the market? And typically a market moves into backwardation when supplies are tight in the front, or there is some sort of short-term fundamental issue with either due to a storm, and the winter storm that we had in Texas certainly moved the front of the curve in oil. It pulled it all up. And I'm using WTI in this example, but for the most part, the benchmark curves are all similar shapes. They might have a little bit of different slope based on some of the global crude spreads. But keep in mind this, we've now, oops, go back to that one slide for a second. If you can go back one for just. So now that we've kind of returned to equilibrium in the back of the curve, you can see that the front is starting to lose some of its value. This was at the beginning of the month, and this is as of last night. And this is, you know, we've kind of hit back to our neutral stance here on oil, and we need some next event to really support this strength in the front of the curve. So if you, now you can go to the next one. Next slide, thank you. One of the key ways that the market and our clients trade the shape of the curve and they express their bull or bear sentiment is through calendar spreads. And there are a host of products that allow you to trade that, from options to the calendar spreads themselves. And people, you know, get into exposure in using these different instruments. But what we can see, this is a plot of the 1 month calendar spreads over time. So the yellow line is again as of last night's settle, and the dark purple line is 10 days ago. So you can see, so this month 1 to month 2 is about flat, and then the second to third month is, you know, 10 cents, and you kind of get more backwardation in the curve as you move into the summer, and then it trails off again. But the level of backwardation has been easing. And that is, you know, kind of a roadblock that, and a theme that we've noticed to the market lately is that, and I think if you move to the next slide, we'll see it. One more down. I maybe didn't order them quite right. Go down one more slide. So this is these 1 month calendar spreads as they're expiring. So we start with the December, January, then the January, February, and they're all expiring in contango or week, meaning that this backwardation that we saw and that shape of that curve in the previous few slides is not getting realized when the front contract expires. And, you know, in a lot of ways, I'm sure a lot of the granular data that, you know, Argus has and that Vlasios was talking about is kind of coming to fruition as these contracts expire. And so all the way into, you know, the most recent 1 month spread to expire was the April, May. And even that couldn't get above, it couldn't hold its backwardation. And you can see it's kind of dragging down the rest of the spreads, and it's made the market vulnerable right now to kind of that next driver, because we have shifted the entire curve higher. So, and yet we can't get any validation at expiration that the market should reflect as much bullishness in the outright structure. And so I think if we move forward here and we can't see these move into positive territory, a lot of these sort of key spreads that people focus on and use as indicators are, starting to collapse. And one of those big spreads that a lot of our clients trade is the difference between summer and winter. And that's expressed in June versus Dece. It's an easy spread to kind of capture that, seasonality. And, for the last year, the spread, we dipped after COVID into very weak, and then very significant contango, and then started to climb our way. So this is the difference between the June contract and the December contract. And over the last, several months, the spread kept moving higher and making, new highs, new highs, new highs. And at some point, if you're not seeing that realized in those front spreads, it makes it difficult for some of these longer dated bullish sentiment to hold. And this June versus December has collapsed significantly from a high of well over $4. And so there are, the structure of the curve is what is being, I would say, reevaluated. We had to factor in COVID and what that meant, and then we took production off the market and, and got rid of some of the excess inventory. And we did that through backwardation, right? Once you have a backwardated market, oil comes out of storage and gets sold because it's now, you lose money holding it into the future. But we're generally reaching a point here where either there isn't enough strength and demand returning to the markets and we're going to mean revert kind of back to a flat structure, or we get the next bullish event that, sends us up again to new highs. But it's caused a lot of sort of overall underlying weakness at the moment that the value in these calendar spreads is coming way off. Next slide. So market structure also, and I mentioned this earlier, it impacts macro trends in inventories. And here we see the blue line is the 1-year calendar spread. So the second month futures versus 12 months out. So month 2 versus month 14. Against the backdrop, the red line, which is crude oil inventory. And we can kind of see here at times when there's significant backwardation, at times when we're drawing down inventory. And we saw that again, kind of 2019. And then when the spread is collapsing, right, it coincides with, a significant rise in inventory. And we're kind of right back to levels that are considered normal or sustainable, with the caveat that OPEC is still withholding a little over 7 million from the market at the moment, and US production is lower. So does that warrant this level of 1-year backwardation? We're starting to see some pause in that too. And overall, I think the thing to watch out for is this flattening of the curve, or what is a good entry point, to get back into this and play for that next upside event. Next slide. One of the other areas that has become highly watched by traders, specifically in refined products like gasoline and distillate, is this renewable requirements. So there are renewable fuel standards set by the EPA, and they define the percentage of biofuels that need to be blended into the final product. And they're grouped into 4 categories. Down here on the yellow, these are a little bit more the ethanol-based RINs, and up here is the D3s are more a classification of biodiesel blending components, so used cooking oil and soybean oil. And these, at the end of the year, a producer needs to look at how much gasoline they produced and sold and was consumed in the US, and they need to have purchased these renewable RINs, renewable identification numbers, that are uniquely identify their, a claim to a biofuel credit. And this market has been getting tighter and tighter as, ethanol prices were so cheap last year, we lost a lot of production. With restaurants being closed, there was less used cooking oil available as an input. And with the situation in the ag market and ag prices rising, the soybean oil futures have also been rising. And this adds to the final produced costs of refined products. And you'll see, throughout, the trading cycle, when these are rallying, you'll see similar rallies in the products. And the concern here is, previous administrations have been open to relaxing some of these standards, and the current administration is less incented to do that. So the stronger these are, the more the refiner margins will could get squeezed if they don't generate the credit themselves. So this is another thing to look for, especially if you're doing equity investing in the refining space, is whether or not they're producing their own blend credits and what kind of tax advantages that gives them against the market. So flexibility and the ability to participate in some of these higher margin processes is going to be key going forward. And I think we can leave it for there and wait for questions. I want Sandra to have some time on hers as well, and then we can come back to questions.
Okay, thank you, Brynne. Thank you very much. As I said, as a former paper trader, both your presentation and Vlasios' presentation are near and dear to my heart. And I hope that everyone is excited as I am. But I think what I'll do, I'll turn it over to a few questions that I have. I'll start with Vlasios, then you, Brynne, and then we can move to Sandra. The first question that comes to mind is the uniqueness of both presentations talking about the market drivers. And so Vlasios, I'll go to you first. How do you fuse both the physical data and the public data, and what do you think your advantage is in terms of the possibility curve?
Yes, so the whole idea is effectively to try to create, in my view, basically, the idea is to try to create signals that are uncorrelated to what your clients are already using. So how do I add some sort of an additional value? Is the additionality that really we are searching? And the idea is to use public information so that you can pick up the information that exists, for example, in the shaping of the forward curves. And then you try to use, is there any additional information that can use to understand the volatility in the market from the physical space? And I keep emphasizing the physical space because this is where Argus has that really unique space in terms of collecting the data set and basically being the benchmark in a number of areas around the world. And this is really the value of additionality, is correlation. It's not just about creating a signal that everybody else can use, it's to doing something extra, something that can enhance, if you like, the Sharpe ratio of the companies on top of what they're already doing.
No, thank you, Vlasios, for that. So my follow-up to that is then, so how do you account for real-time events such as what COVID has done to supply and demand, or the negative impact of crude in, I think, April of last year? How do you adjust for that?
Yeah. So I got to say something from the outset is that we cannot predict if an event, in an unexpected event happens, let's say an attack in a particular asset, or if there is COVID. But what we can do is that when an event happens, using that physical data around the world for different locations, is to try to assess the impact of that event on the prices. So that might not sound significant, but imagine that there is an event like a COVID that the information is not, the full information is not known to the market, but you try to understand what does it mean in terms of the demand side, in terms of the refined products. And if you have that information around the globe, you start seeing some impact that's happening in China on your prices there. Then that gradually starts impacting what's happening in the Asia Pacific, and then gradually comes to Europe, and then gradually happens in the US. So the whole idea is to try to find out the data that is global and regional at the same time, so that you can try to basically estimate the impact of that event into the price formation. And that's really the core, if you like, product that Argus is offering.
Thank you, Vlasios. So, Brynne, before I go to you, just an interesting time to get Sandra to have some speaking time. I would like to ask her a question, but I want to tie it back into something you mentioned on RINs. Sandra, so over to you. Thank you for being so patient and waiting, sitting through the presentations. So, the first question I'll ask you is, why do you regard renewable energy as a positive impact theme?
Thank you, Kwhame. So we look at impact from 3 angles. We invest in positive impact themes, and then we utilize ESG and controversy data to analyze which investments to be invested in. And then thirdly, we pledge a significant portion of our performance fees straight for impact to go help underserved communities in the global south to be more sustainable and on their local footprints. So renewable energy plays a very large part of our positive impact themes. In fact, I would say it's a crucial part. If you look, energy consumption accounts currently for 73% of global greenhouse gas emissions. And that is expected to increase quite significantly in the next 30 years, unless we choose to do something different. And it is fantastic to see that post-COVID, this year, 2021, is expected to be the energy sector, renewables is looking to increase, or the investment in renewables will be more than traditional investment in the oil and gas sectors. And there's many benefits. Obviously, we will have reduced air pollution. Just looking at the stark numbers of COVID last year, air pollution is estimated to take 7 million lives every year. And then obviously the myriad economic benefits helping rural communities to be more sustainable. And it absolutely helped to reduce greenhouse gas emissions. So for sure, a very important and crucial investable theme for us.
Sandra, I have a follow-up to that before I go back to Brynne. So top of the list, top 3, what are your alternative investment in energy strategies that are on the top of your radar right now? If you had to give us the top 3, what are the top 3 that are on the top of your radar right now in terms of alternative energy sources?
So clean energy, including solar power, wind energy, hydropower. And for us, it has to be a very liquid and tradable liquid equity. We also look to the future as to what is happening in the space. And it's fantastic to understand that energy derived from algae and the ocean wave power, and new solar panels that is launched in space to help beam down very targeted solar power down to specific reception points on Earth. So those are future areas that we're looking at. At the same time, we look for liquid tradable strategies.
Thank you, Sandra. I'll switch back gears to Brynne, Sandra, and then I'll come back to you. But staying in the renewable space, Brynne, based on what Sandra just said and your presentation on the RIN market, do you expect the RIN structure to stay that tight going forward as we come out of COVID? Any thoughts on renewable structure, just staying in the same renewable space that Sandra's referring to?
Well, certainly, you know, as Sandra points out, the growth in the application of renewables and the pervasive nature that's expected to happen over the next 5 to 10 years makes a backward structure in crude makes sense, because people are worried about the future of fossil fuels, right? And then on top of that, we have these renewable credits that have had kind of a checkered past, on whether or not they've been enforced and how serious the market has been about them. And, I think there's a critical mass definitely right now. And unless, we have the ability to quickly ramp up producers of these credits, we're going to see a spike probably in the next year or two until those prices are sustainable for long enough that people want to invest in it. And so really from a, just an infrastructure standpoint, we are behind the curve on generating these credits. And that is, the only way you can grow production, or, if we have any sort of forecast going forward that gasoline demand might go up from here, from these levels, you're going to have an increase in your requirement for your fuel standards. And so I think there will be quite a bid under them until we get some critical mass in production. And at the moment, they're all smaller projects spread out across the world. And these are specific to the US.
Right. So a follow-up question, Brynne, staying in that theme, what does that mean for crude structure? If we can anticipate gasoline demand going up, coming out of COVID, we can all hope. We can anticipate pressure on the renewable space. What do you think that means for crude structure? You did in your presentation earlier, you talked about structure currently being backwardated and how spreads were performing. If you have to forecast out, and I know forecast and forward, everybody's going to say, you don't put them together, but if you have to forecast out for the forward market on crude, what do you think that means for structure?
So I think the lack of investment flows into the traditional energy space will keep the back of the curve muted. However, margins are really thin right now for producers, for refiners, and they're going to be in search of things that increase their margin. It happened in the electricity space. You get credits for wind and solar and priority dispatch on the grids. And we saw some of the fallout of that this past winter in Texas. And in that way, I think we're going to continue to require, that greening up of production in our, traditional fuel space. And I think traditional fuel prices will remain under pressure, and greening up or being able to produce or configure your system to capture the additional tax benefits of biofuels will become the focus going forward. So it will be less on the price of oil and more on, the bottom line margins of, and massive increase in oil prices would be, it's a different time now. Moving into the future, prices get too high. There are more levers for consumers to pull. There's more electric vehicles available. There's more demand response programs. And so I would imagine the structure will remain in backwardation just due to a lack of buying in the future.
Okay, thank you, Brynne. I'm going to switch back gears to Sandra, and then I've got one more question for Vlasios. On that theme, Sandra, how data sensitive is your strategy, and what data sources do you use when you start evaluating exactly what Brynne was saying? What is supply and demand going to do to our forecasts, our forward curves, our outputs into the future? How data sensitive is your analysis, Sandra?
Well, we are ferocious users of data, and I would argue that the data structures currently existing in the oil and gas markets needs to be transferred to a clean and green energy markets. So it took years to develop that, and data sets must become real time in green energy as well. And I would add to what Brynne is saying is that the market may potentially remain in backwardation, and very particularly reduce out-of-pocket costs for everybody involved. It is currently so much cheaper to be invested in clean energy, and from a consumer perspective, that is a very big benefit, and ultimately arguing that with productivity increases as well as reduced cost of renewables, it may keep inflation intact, which is very important for future growth. For us, we look at global macro indicators, so supply and demand factors. We look at fundamental data as well as ESG data, including all the controversy scores, specifically surrounding very particular energy intensive practices. And then we utilize technical analysis. So utilizing each one of it, fundamental, technicals, and ESG data as part of this lens to look deeper and closer to an underlying liquid equity that we are looking to invest in.
Thank you very much, Sandra. Thank you very much. Vlasios, staying in that data theme, how do Argus possibility curves differ from other analytical tools? Just staying in the data team, what is your big differentiator in terms of the data science product that we're putting out, staying in the data team that Sandra was just discussing?
Yeah, so I think my answer actually, it fits very well with what Sandra has said, that is the idea is that you need to start having as quickly as possible, as near real-time data as possible. By real time, I don't really mean like the same way as a trader means on a minute-by-minute basis, but data that can give you basically what's happening in the world right now, so that you can understand the impact that comes from the various spaces. But what we have done, however, at Argus is we took that a bit one step further, and what we said is that if you have that data set and you just take data science techniques off the shelf, it's very unlikely this is going to give you something really good. You have to get some sort of these techniques and make them work for the specific markets that you're trying to understand. So in other words, what I'm really talking about, fusing market knowledge with the data science and the unique data set to come up with something unique. So it's not all about data, it's also about how the data is analyzed, and we should not underestimate the importance of the knowledge someone has about the market to customize the way the data needs to be analyzed. And if you just analyze a data set and you already have a preconception, you can always get a convention out of that data set. So let the data speak, and how you let the data really speak is by putting some sort of a constraints that are market driven, so that you can really see what's happening. You can really identify the emerging trends as soon as possible. So Kwhame, just to summarize, the answer is data, market knowledge, and customization of the way that data needs to be analyzed is the key.
Got you. And the secret science is when Vlasios puts it in his think tank and spits out the answer, and it tells us where the possibility curves will arrive. I hear you. We have 3 minutes, and I think I want to go to one question that we kind of partially answered. And I'm going to start with ladies first, but I'll ask for a minute each to answer this question. Sandra, I'll go to you first, and Brynne and Vlasios to close. But Angel has a question online, and we kind of answered this question, but just any more thoughts if you guys want to answer it. I would like to know to what extent different political initiatives can affect the market in the short term can be factored into the data model. So essentially, Vlasios, you talked about it, Sandra, and when you all talked about it, but anything else you guys want to add that will have an impact on the model, and also how often do you update the models if something were to happen? Sandra, I'll go to you first, Brynne, you're next, and Vlasios, you're last, but I'll say we have a minute each to answer.
I would argue that any data model needs to incorporate as much real-time data as possible. And with the rise of artificial intelligence, it is absolutely possible. So there's this amazing opportunity in the next 10 years to really get a real-time sense of supply and demand, the sense of what is the associated cost and where to focus resources and technology. And with that, we think it's amazing to be in this space. We truly live in a transformational age where data will become real-time, transparent, and more democratic, and ultimately reducing the out-of-pocket cost to the consumer, which we so desperately need worldwide.
Thank you very much. Brynne, over to you, same question.
Well, it's interesting because there is a lot of real-time data available out there. And when I say data, it could be headlines, it could be, models like Vlasios, and, fundamental data. And, I think you have to differentiate between, are you trying to react to every little single, feed that comes in, right? And you can kind of see that in the futures market. It gaps up and down as some of these algorithms, a headline hits them right in real time and they make a reaction. Or, are you using those as tools to evaluate against where the current market is and, identify, which side of the market you want to be on. And I think that's a lot of the value of the completeness of data, and not just relying on a weekly inventory report or, a market call by Goldman Sachs. It's a very comprehensive market in which prices get boiled down into almost indexes with WTI, right? A benchmark with Brent, with, Dubai, and the new Murban crude. But those, benchmarks are the accumulation of all of this data under the hood. And I think I want to highlight that don't ever consider that, just participating in getting one of these pieces of data real time is enough. And I think the complexity of Vasily's model shows how much data there is out there that needs to be boiled down and then essentially evaluated against the current market. And we're now in an environment where we've changed administrations. There's a lot of geopolitical risk that needs to be factored in a different way maybe than it was last year. And so, yeah, completeness of data. And I think, hence why these spreads are where people look to kind of assess the relative value of one thing versus the other based on all of this underlying data.
Thank you very much. Vlasios, final word for you. Over to you. Same question. I think it would also help to expand how often it is you update the data to Brynne's point, because the data does change constantly. I think if you could touch on that, would be very helpful as well.
Yeah, so Kwhame, that's a really good question. I'm afraid there is not necessarily a really good answer. It's technically so difficult to incorporate the latest data set into an existing, if you like, process or analysis that you do, because it can really destroy your whole model. The way we've done it really at Argus is we try to say what are the best proxies. So if there is a data set that's for a very short history, but it gives you an emerging event, is there any data set that we have curated really well for a long period of time that we can use it as a proxy to capture the impact of that event? And if I use the example about the stock levels, of course, as part of our analysis, we use the stock levels that are published by the EIA. They're a very important piece of information that is coming out every Wednesday. But we are also having an additional data set that can help us whether there is any significant change during the week, which is the volume of data that is moving the pipelines in the US. So the idea is that you something that you really curate properly, that you really spend enough of your energy and resources to make sure that data set is accurate, is reflective of the market, and try to enhance what is publicly available on a weekly basis, what you are actually doing on a daily basis. And both of them at the same time is where you add most of that value and try to capture the emerging trends during the week.
Thank you, Vlasios. We're at the top of the hour, guys. So at this point, I just want to thank the wonderful panel. Sandra, thank you for being patient. Brynne, thank you for your analysis. Vlasios, thank you for your analysis. And again, it was interesting to tie in, I think, the renewable space versus the future space versus the data science space. Obviously, we can see that data and market drivers are at the core of all of the analysis. And so I think it's been a great learning experience for me. So on behalf of HFA, on behalf of the attendees, just want to thank you guys for being patient and sharing your thoughts with us. If anyone has any questions, I'm sorry I couldn't get to all of them, please feel free to reach out to Mitch and he can get you in touch with Sandra, Brynne, or Vlasios. And thank you so much for your time. Have a good day, guys.
Thank you. Thanks.
Thank you.
Thank you.